LegacyNetDebt.com. And today we're going to do a really quick story about you have been lied to, the problem with averages and your money. What some professionals will not tell you about averages. Well, before we got started, I just received 2 emails, literally just in the time that I was preparing to hit the record video button. I got 2 emails. One of them says, double my IRA. It's from a brand, the person that promotes that they can guarantee I double my money in 3 years if I follow their plan. Let me ask a question. If the market goes south 40% next year, are you going to guarantee I double my money? Second one is from a company that I do business with, and it's an email about individual products. Know the risks of large multiplier products. So this company offers a product, a policy, a vehicle that allows large multipliers and bonuses after X number of years. The problem is there's risk that goes along with the bonuses and multipliers. Although these emails aren't related to the story, I guess it's part of an overall story of people not giving full disclosures, companies not giving full disclosures of what's at risk when you put your money on the table. So let's talk about the story. We'll go through the story. It should take 2 or 3 minutes, and at the end of it, hopefully you walk away with something to think about. You've been lied to. The problem with averages and your money. Say, right now, you have $100 in your pocket. Would you accept this offer if I told you I'm going to give you 60% today, this year, only for you to give me 50% back next year? Would you think on the surface that's a good idea? Is that a good offer? Would you take it? Furthermore, if you trusted me, if you didn't have any other information and you knew me and you trusted me and I said, look, you got to take this offer. I'm going to give you 60% this year. You only have to give me 50% back next year. You might think, well, it sounds like a good idea. The reality is this is the type of offer that's made to you and me and everyone else on a daily basis. A trusting person might say yes. People do this every day when listening to their financial planners, when listening to Wall Street, when listening to the stock market, living the dream of the stock market. People do this every day with their 401k. They do it with their self-directed IRA. They do it with many, many things. The hope of living the dream. What if I do win? So let's take a look at the math. Peel a layer of that onion away and look at the math. What they will not tell you. This year, we start with $100 and we add 60% or $60. So at the end of this year, we end up with $160 total. Then next year, we're going to follow through on our promise, on our offer, and we're going to give back 50%. We're going to give back 50% of that 160, which is 80, and we now have $80 left in our pocket. Well, what happened? Doesn't make sense, right? Well, Houston, we have a problem. Some people are going to say, you made 10% because we gave you 60 and returned 50. And when you add them up an average amount and add and subtract an average amount, it's 10% net over 2 years. That's 10%, right? Well, it's not right because you actually lost $20. So Houston, how do we fix the problem? It's simple. Understanding how to protect your gains is where it starts. So let's use that same scenario, but just tweak it a little bit. $160 after year 1, but we're going to take $60 off the table and we're going to start again with $100. Now in the scenario where we give back 50%, we give back 50. So out of that 100, we give 50 back, we're left with 50. But what we did is we locked in that $60 we made last year. And indeed, what we have is a $10 gain year over year for 2 years. It's not sexy, but it's a true $5 gain. It might not be a story that you tell your drinking buddies. It might not be a story for your buddies out on the golf course. It might not be a story for your grandchildren. There's nothing sexy about it. But what it did is it locked in that gain that you had. In closing, I'd just like to say, Wall Street, your financial planner, your bank, and the IRS is never going to tell you to take money off the table. They want you to keep that money on the table. They have a vested interest in making sure you have as much money as possible on that table at any given time. Do you think the dealer at the casino is going to say, hey, take some of that money away? We don't want it. Just only play with half your money. They're never going to tell you that. So in closing, what I'd like to say, it's invaluable, very important to learn how and when to take money off the table, how and when to take risks, how and when to come back from taking risks, when it's right not to take risks. So don't be that person that wins big at the casino, leaves it all on the table, only to lose a lot or all of it when things go south. Protect your gains while you can. And if you need an example of what can happen with those gains, all you need to do is rewind the clock 11 years and look what happened to people's pensions, 401ks, investments during the years 2007, 2008. It was not pretty. Once again, my name is Mike Lucy from leavealegacy.debt.com. I can be reached by phone or text at 734-288-8323, or you can find me and our team on the web at www.leavealegacy.debt.com. Thank you for watching. I hope this was helpful, and until next time, bye now.